IAS 37. To just recap. So then we start the class by 9:30. So because I noticed if we could just continue the class like that, there will be biggie, because we did that. Okay, was it not last week that we did it? Oh shit. Where is the SBR class now? Okay. Sorry. I think I've sent the link to all the group now. So I've sent the link to the group. Okay. 1, 2, 3, 4, 5. Yes. Okay. So good evening, everybody, once again. So as I've said earlier, we are solving past question IAS 37 tonight. So when I check here, I can pass question. I can only say only 3 questions. So what I did was that I said we are going to treat those past questions in our revision classes. So I now found another past question that is very valuable, an ACCA past question. And just like I said, maybe I forgot to I forgot to say it, that please let's be conversant with ACCA past question, because SBR was adopted from ACCA. SBR was adopted. SBR is in ACCA, so I can adopted it from ACCA. So we should all be conversant with how ACCA set question, and that's the reason why I said I'm going to be sending questions and solutions on standards, so that we are going to know. Because when I look at your last diet past question, I found 3 ACCA past question in your exam last diet. 3 that was just brought out from ACCA like this, and I can't set it. And that's the reason why the CR question was very thick. So now let's quickly start. So for tonight, let's quickly use 10 minutes of our time to discuss about IAS 37. Fine, we discussed about it last week. So IAS 37 describes provision as a liability of an uncertain timing and or amount. That is a liability. I said, in line with the conceptual framework, a liability is a what? Is a present obligation to transfer economic resource as a result of past event. A present obligation, a debt you are owing currently. So provision, for you to recognize a provision, there must be an obligation. You must be owing somebody. There must be an obligation. And that obligation, as we said it last week, it can either be constructive obligation or legal obligation. And I said it last week also that legal obligation is as a result of contract with another person or the law, while constructive is an obligation whereby you don't have any relationship with another party, but you create that obligation as a result of something. That's the reason. That's what I said last week, if you cannot remember. Now, and I said example of provision. Number 1 is decommissioning or dismantling cost. Number 2 is environmental cleanup cost. Number 3 is warranty cost. Number 4 is restructuring cost, onerous contract, litigation, and other claims where certain criteria are met. And I said in when we are dealing with provision, recognition criteria of provision is very, very key. It is very, very key. Number one is that the entity must have a present obligation. As a result of past event, there must be an obligation, a present obligation. Now, number two, it is probable that the entity will transfer economic resource to another party. That means that economic resource that I told you last week, don't let it to go you. What economic resource means is that cash, asset, or that is something you can use to settle your obligation. So for you to recognize provision, it must be probable that you will settle it with cash, asset, or any other thing with another party. Then thirdly, the obligation must be reliably estimated. And I said we should all know that all three criteria must be met. And I said an obligation can either be legal or constructive. So number one is constructive, is as a result of when an entity publish policies, create a value expectation among other parties. When you publish a policy and that policy now became an obligation on you, then as a result of established pattern past practice. Then legal is very straightforward. It's as a result of contractual obligation. That means you enter a contract with another party. Then legislation and operation of the law. So that is legal. Then, and I said recognition of liability. I said it that it must be probable. When it is probable, that means there is 50% chance that you settle that obligation. IAS 37 says it is probable. Then possible is less than 50%. IAS 37 says it is a contingent liability or contingent asset. Then remote, it's a contingent liability, but you ignore. When it's a possible obligation, you disclose. Then virtually certain, that means 95% you should recognize. So we are just recapping measurement of provision. So provision should be measured based on management best judgment, taking into consideration of historical, present information, and forward looking. And I added this to the note that a report of an independent expert may be required. An example is solicitors, baristas, surveyors, and technical experts regarding the commissioning process. So they are the one that will give you information before you can estimate that cost, before you can measure provision. So IAS 37 recommends two methods, which is number one for warranty costs. When it is the provision is of large population, example is warranty cost, we use the expected value method. Then when it is of single or one-off obligation, like litigation or restructuring costs, we measure based on most likely to settle. So that is about measurement. So we started talking about all the examples of provision. Number one is the commissioning or dismantling cost, which is a cost in which an entity will incur in the future to restore an asset or a land back to the normal state. And we said it that it's going to involve time value of money, especially when it is material. So discounting is very, very appropriate when we are dealing with dismantling cost, because it is a cost you incur in the future. So you must use discounting, especially when it is material. Then we talk about environmental cleanup cost, which is the cost of environmental damages. Then we talk about future operating losses. We talk about restructuring costs. So IAS 37 talks about restructuring costs. Then we talk about reimbursement, that when you are expecting money, you can only recognize it when it is virtually certain that you will receive that money. And that reimbursement should be recognized as a separate asset in the financial statement. Then I talk about onerous contracts. That means a loss-making contract in which the unavoidable costs of meeting that obligation, of settling that contract, is higher than the benefit. That means the cost in which you are going to use to execute that contract is higher than the cost. So since it is an onerous contract, you must fulfill the contract. So IAS 37 says that you must recognize provision for the loss in the financial statement. And the present value or the fair value of the minimum cost is the lower of the present value of the cost and the present value of penalty, the lower between the two. Then we discuss about contingent liability, which is a possible liability, a possible obligation, a liability that is not sure. And IAS 37 says that we should not recognize it in the financial statement, but we should disclose it. We should disclose it. Then that is about then contingent asset also the same thing. So that is just a brief on IAS 37. In case I know it is possible, some of us are very, very busy, just like me too. Since that last week, that is it last week or 2 weeks ago that we discussed about provision, we just dropped our notes that it's okay like that. So now we are going to be solving two past questions tonight. We are going to use less than 15 minutes to solve the first one. That one is very, very straightforward. So okay. Let's continue. Let's continue. So can you see my screen now? Okay. So these are the two questions we are solving tonight. The first one is exhibit 1. Sorry, I need to correct this. Okay. The first one is exhibit 1, while the second one is exhibit 2. Now we are going to pick it one after the other. Let me enlarge my screen a little. Okay, I think it's fine like this. Now let's look at it together. So now let's look at it together. Let's look at the question together. Now, exhibit 1, legal case. As at 31st March 20x2, Delta was engaged in a legal dispute with a customer who alleged that Delta had supplied a faulty product that caused the customer actual financial loss. The directors of Delta consider that the customer has a 75% chance of succeeding in this action, and the likely outcome should be the customer succeed is that the customer will be awarded damages of $1 million. Now, the director of Delta further believes that the fault in that product was caused by the supplier of the defective component by one of Delta's supplier. Delta has initiated legal action against the supplier and consider that there is 70% chance Delta will receive damages of 800,000 naira from the supplier. So this is exhibit 1. Now I want to quickly ask a question. Exhibit 1 is talking about legal case, right? It's talking about legal case. Now, and we all remember example of provision. Number 1, the commissioning cost, restoration cost, onerous contract, what is it? There are all those type of examples. So now, looking at exhibit 1 now is a legal case. Now, let's look at the requirement together. Let me scroll down. Using the information in exhibit 1 and 2, explain and show. That's what ACC usually do. But let me just use show so that our time will not go. Show how these events will be reported in the financial statement of Delta for the year ended 31st March 20x2. That's the requirement. That this legal case, so how are we going to report it in the financial statement of Delta? So now, to solve this question is a very short question. Now, the information we have, I want to ask a question. Number one, according to that legal dispute, please, maybe we can use the chat button because I don't want the class to be rowdy. Please, if you want to answer the question, please, you can just raise up your hand. Now, the director estimates that according to this court case, there is 75% chance that the outcome will result to a loss, that the customer is going to receive a damage. The damages will be awarded damages of 1 million. So according to that information, I want to ask a question. Are we going to recognize provision? That's my question. Are we going to recognize provision? And why are we going to recognize the provision? Okay. Why are we going to recognize the provision? And are we going to recognize? Okay, I already see. Okay, I already see hands up. Okay, because it is probable. That's fine. Okay, that's fine. You can use yes because it is probable, and it is more than 50% chance, right? Thank God, we all understand it. It is because it is very, very simple. It is very, very simple that IAS 37 has given us guideline that when it is probable that the liability is going to occur, that means there is more than 50% chance we are going to recognize provision. We are going to recognize provision. Now, that's by the way. Now let's move on. Now, the second information, that's why I said this question is going to just take us 10 minutes for us to just fix. Now, the second information, the director now believes that the fault in the product was what? Was caused by the supplier of defective components by one of the Delta supplier. So, and what are we saying? They said Delta initiated legal action against the supplier and consider that 70% chance that Delta will receive damages of 800,000 from that supplier. Now, the question is that Delta to now will now initiate an action against the supplier, and there is now 70% chance. So, my second question is that are we going to recognize this 800,000 from the supplier? Are we going to recognize the 800,000 from the supplier? You know, they told us that there is 70% chance. Are we going to recognize it? Okay. People, we can all use the chat box. We can all use the chat box, please. Let's use the chat box. Okay, yes. Everybody said yes. Okay. Mr. Solomon said it's a contingent asset, right? So okay. Any other option? Please, let's use the chat box. I'm seeing it right now. I'm seeing it. Okay. Majority of people said we are going to recognize it though. Majority of people say we are going to recognize it. So okay. Now let's settle it one after the other. It was Mr. Solomon that got it right. Please don't let us sleep over it. Don't let us sleep. This is a contingent asset. This is a contingent asset. Do you know that Delta is paying that customer? So that is an obligation. That is a liability. We are going to recognize provision on 100%. Everybody, we got that right. But this second one, You did not get it. Majority of us did not get it right though. Please, let's take notes. The second one, it is a contingent asset. Delta is expecting, as a result of that legal action against the supplier, Delta is expecting money. How much? 800,000. So that is an asset. Now, when you now look at it, IAS 37 give us guideline that for you to recognize an asset too, there must be 95%. It must be virtually certain. It must be virtually certain. Let me go back to the note. And that's why I said, let's quickly read the note. Let's quickly look at it together again so that we will all be fine. Let me show you again. When it is contingent asset too, look at it. IAS 37 defines contingent asset as a possible asset when you are expecting money from somebody. That is receivable, right? That is receivable. Or in line with IFRS 15, they call it contract asset. Receivable or contract asset. But here we are not dealing with IFRS 15. When you are expecting money from somebody, it is a receivable, it's an asset. So IAS 37 defines contingent asset as a possible asset which arises from past events whose existence will be confirmed by occurrence or non-occurrence of future uncertain events which are not within the control of the entity. IAS 37 requires that contingent assets should never be recognized in the financial statements. A disclosure is required in the notes if they are material. Now let's look at our, please just be with me here, be with me here. Now let's look at it. There is a guideline for recognizing asset and liability. Look at it. From the top here. And that's why I said, let's test the question. Look at it. Virtually certain. Virtually certain. For you to recognize for you to recognize an asset, it must be virtually certain. Please, let's take note. For you to recognize an asset in the financial statement, in line with IAS 37, that means a possible asset, it must be virtually certain. That means it must be 95%, more than that, 95%. So let me just add it here. Please, let's take note. Reimbursement, and this is it. It is even here. Let me show you here. There is no need for me to add it. Look at it. Reimbursement. A reimbursement is as a result of contracts arranged to cover a risk or warranty provided by a supplier. IAS 37 requires that reimbursement should be recognized if and only if it is virtually certain that it will be received. Look at it. In that question now, Delta has done what? Delta has gone to the court. Now they now told her that it is only 70%. So it's not up to 95%. If it is 95%, Delta will recognize that what? It will recognize that 800,000 as a possible asset, as a reimbursement. But here it is only 70%. So we cannot recognize it. So does everybody understand why we will not recognize that 800,000 now? Let me see your reaction. If you now understand, let me see your reaction. Let me see your reaction. Thank you. So please don't let us sleep over it. Don't let us sleep. Let us wake up. So when it is an asset, a reimbursement, it must be 95%. It must be 95% before we can recognize. But look at it now, it is a contingent asset. It is a contingent asset. So we are going to disclose it. Just like one person just said now, we are going to disclose it in the note to the account. In the note to the account, we are going to disclose it. So that is it. So let me quickly show the financial statement extract. Let me quickly show the financial statement extract. Let me quickly show the financial statement extract. What is the accounting year end of the business of the organization? Is 31st March happy? 31st March. 31st March. So let me quickly show the financial statement extracts. Please look at my screen. Look at my screen. Because they asked us to show it. So what is the name of the company? Delta Abbey. We are not even told that maybe it's Delta PLC. So Delta statements of profit or loss. Let's use Capitalization. Statements of profit or loss for the year ended. For the year ended 31st March 20x2, right? Yes. Now let's do it like this. Let's reduce this. Let's merge on this. Let's match delta to like this. Now let's use our dollar sign here. This is our dollar sign here. So the first one that we are going to recognize is our operating expense. Our operating expense. Operating expense. How much are we going to recognize? We are going to recognize a provision. Provision for damages. Okay, let's say it's legal. Provision for legal damages. How much is it? They say we should recognize 1 million, right? 1 million. Let's write it in full. So operating expense. So we recognize this. So let's copy this and paste it here. Copy and paste. Let's paste it here. So this is statement of financial position. Statement of financial position as at 31st December. Let's copy this now. So now first and foremost, we have asset Abi. We have assets, non-current assets. To just show the examiner, you know what you are doing. We have the non-current assets. We have the current assets. So under the current asset, just show examiner. Legal, that reimbursement that is expecting, legal damages from supplier. There are so many ways to put here. You can use any of from supplier. You know we are supposed to recognize it if it is virtually certain, right? But it is not virtually certain. Just put dash here. Just put dash. Examiner will know that you know what you are doing, that you not recognize it. But just put, now let's go to our current liability. You know, provision has two legs. Provision has two legs. So when we debit our expense, we are going to credit our liability. So we recognize that 1 million here. So that 1 million will be here. So we have shown This is it. So we are not going to. So what I did here, hope everybody now got it now. They asked us to show our financial statement extract. How we are going to recognize it in our financial statements. This is it. It is only that provision for legal damages to customer. Provision for legal damage to customer. Let me put it here. To customer, let's say X. As that 1 million, we recognize it. We'll debit provision in the P&L. Then we'll do what? We credit our provision in the SOFP. But for the legal damages from supplier that we are expecting, IAS 3070 we should not recognize. You just put that here. So this is how we are going to show our financial statement extract. So let me call this one solution exhibits 1. So that when I send this Excel, you remember this is exhibit 1. This is exhibit 1. And this is exhibit 2. So now are we fine with that? Let me see your reaction. If you are fine with that, number 1. If you have any question, please let's fix it too. Before we move to number 2. Number 2 is the one that took time. Okay, Mr. Solomon. Mr. Solomon, I want to ask a question. Okay. Oh yeah, Mr. Solomon, quickly ask a question before we proceed to the next. Mr. Solomon, you are now unmuted now. Please go ahead with your question.
All right, sir. My question is this: are we not supposed to recognize these items in the statement of financial provisions?
Which one? Which one?
The provisions under the liability aspect.
Yes. Are you not seeing my screen? You are seeing my screen, right?
Yes, I can see it, but I didn't see where you inputted the figures.
Okay, I think you did not see my screen very well. Let me scroll down. So you can see it. We have recognized it as liability. Look at it. Under the current liability, we have recognized the provision for legal damages. Can you see it? So you remember that the accounting entity is to debit your P or L, then you credit your provision in the SOFP. So this is the credit. This is the 1 million credit you credit, and then this is the one you debit in your P or L. But for the second one, which is 800,000, we are not going to recognize that one. We are just going to disclose in the note to the account. And we cannot do note to the account here. Then we are now going to be talking stories. It will not be induced. So hope you get that now, Mr. Solomon.
Yes,
Hello?
thank you so much.
All right.
Yes, I did.
Okay. So that's it. So, Mr. Kyle, they want to ask a question. Please, can you just type it in the chat box? We need to move. Because the second question is going to take us time. And I don't want this class to exceed 11 o'clock. Okay, you can ask here. Please ask here. I don't want this class to exceed 11 o'clock. At least by 1 hour, we can solve that second question. So everybody, there's work tomorrow. Let's go and sleep. There's work tomorrow. Okay. Nobody is laughing at me. Are we not going to go to work tomorrow? So now, let's go ahead with the second question. The question is also a CCA question. So I have said it earlier that the past question will be solved during the revision. It will be solved during the revision. Now, extraction, mineral extraction, that's exhibit 2. That's exhibit 2. Now, on 1st April 20x1, on 1st April 20x1, Delta purchased some land for $10 million. So Delta purchased the land in order to, okay, and Mr. Okay, please kindly send the note to the group. I have sent the note to the group now. Okay, maybe you are just joining. I've sent the note to the group. I will send it again. I've sent the note to the group already. Since last week, I did it. So now on 1st April 20x1, Delta. Okay. Just to confirm that my screen is not visible. My screen is visible. Please help me confirm. This screen that as large like this. Mr. What is that? Let me check his name. My screen is visible now. Even people on YouTube are seeing my screen. People on YouTube are seeing my screen. So just to confirm, 95% of the claim define the word virtually certain. It will not be recognized rather than disclosed. Yes. So assuming in the question that they told us that Delta now sue that supplier, then it is 95% certain that Delta will receive 800,000. So if they told us that it is 95% that Delta will receive 800,000, so it is virtually certain. So we recognize that 800,000 as a separate asset in the financial statement. But here they told us it's the 70%. So IAS 37 have already told us that we cannot recognize, we will disclose. So somebody say I did not send the note to group 4. Please, I will send it, please. I will send it. Don't be annoyed, I'm very sorry. So now let's move on. So Delta purchased a land for 10 million naira. So this is the way I solve question, and this is the way I was told by my lecturer, by my mentors, and that's the way I usually advise my students and my colleagues. Please, anytime you are solving every time you are solving question on standard, please always highlight information. It will make life easy for you. It will make life easy for you. They told us that Delta purchased land for how much? For $10 million. Just use your pencil in the exam. Just use your pencil to do what? Just use it to highlight. Just use it to highlight. Highlight in the exam. Wait, I'm sorry. Yeah. Sorry. So, okay. This is what I want to do. Those information, I like them. Those information are what you are going to be. But I usually see that when you set standard question, except question that is very, very thick, there is no how you will score at least 10 out of 20 marks. Because it's not the final answer they will mark. They will be marking step. So if you can report that this 10 million land is a PPE, you get your mark. Even though it's half mark, you will get. So please let's continue. Delta purchased this land in order to extract minerals from it. During the 6 months from April to September 20x1, this date is very, very key. Very, very key. Please let's also highlight it. Delta incurred a cost of 3.5 million naira, preparing the land, erecting equipment. In line with IAS 37, are we going to capitalize this 3.5 or expense? If I say maybe we can remember. Can we still remember when somebody buy land to do what? For extraction of mineral, They now buy equipment. The equipment is going to use to erect the land for extraction. Are you going to capitalize? Yes, okay. You are going to capitalize. So 10 million point plus 3.5, that is 13.5, right? Fine. Please, let's continue. This process causes damages in the land. That process cause damage. Please, let's take note. Now, Delta began extraction of minerals on 1st October 20x1, and estimated the director estimated that there are sufficient minerals to enable the site to have a useful life of 10 years. Now, that land has been, uh, they bought a land, then they bought an equipment that will be used to erect an equipment that will be used for extraction. Now, on 1st October, they now give us information that that land and the equipment it is going to load. It's going to give us sufficient, there are going to be sufficient minerals that will enable the site to have a useful life of 10 years from that date. That means what they are saying is that when you first look at this question is like IFRS 6. IFRS 6 is exploration or evaluation of mineral resources. But this question is not IFRS 6 at all. Please, let's take note. This question is a PPE. When we buy land and we construct a factory in line with IAS 16, is factory not a PPE? Yes, it's a PPE. Because it's for production. So here, our PPE is 10 million point plus 3.5, which is 13.5, right? Now, they now give us information that it will be probable that future economic benefits will flow to the entity. Abi, because this is the future economic benefit. There is sufficient mineral that will enable the site to use its life of 10 years from that date. So there is future economic benefit. And that means what? And that extraction, which will give us mineral resources, is going to have a useful life of 10 years. So we can confirm that this is an asset, right? This is an asset. That information is telling us that this is an asset. And secondly, this information is also telling us that the useful life is going to, there will be sufficient minerals for 10 years. That means this information of 10 years is for what? Is for depreciation. Is for depreciation. Now, let's continue. Further damages to the land is caused as the mineral is extracted. As the mineral cost is cost, okay, are cost as the minerals are extracted. As they are extracting minerals, there are further damages, further damages, further damages. They now told us that Delta is legally obliged to rectify the damages caused by the depreciation and mineral extraction. Can you see now? There is an information now. Delta is legally. This is a legal obligation to rectify the damages. So now, and the reason why I said we are going to I'm going to solve this question is because I remember my Oga, Mr. Michael, taught you IAS 16 last week. So IAS 16 and IAS 37, they are somehow connected. And this is a question that brings them together. So this information that there is an obligation to rectify the damages, that information is the commissioning cost. Please don't let us sleep. When an organization has a legal obligation to rectify damages, that information is the commissioning cost. So there is a decommissioning cost in this question. Now, the director estimated the following costs will be incurred. Number one, $3 million to rectify the damages caused by the land preparation. That is number one. Number two, 200,000 naira each for the extraction for the process of rectifying the damages. For the land preparation, they will rectify. Then uh, for the extraction process too, they were going to spend how much? 200,000 each year. So my question, let me quickly ask question before I quit. Now, for damages caused by land preparation, they are going to spend the total amount of how much? $3 million. However, for extraction process, what is the total amount they are going to spend? Let me ask that question before we go. What is the total amount they are going to spend for extraction process? 2 million. Another attempt, what is the total cost? The total cost for extraction process, which is that number 2. What is the total cost? You know, number 1, for land preparation, they will spend 300. Thank you. Thank you. Thank you, Mr. Flash and about 200,000 times 10 years. Please don't let us repeat it. We are now in professional. That's why I highlighted those. If I want to scatter everything, I'll just highlight that 200,000. But the reason why I highlighted 200,000 for each year, and they already gave us the estimated useful life of this extraction process, which is 10 years. So 200,000 times 10 years, which is how much? 2 million naira. 2 million naira. So that is, please let's take note. Please let's take note. Now we are going to go. Let's go. Let's go. Now, annual discount rate for this project is 12%. As I've said it that when we are dealing with the commissioning costs, and the commissioning cost is material, there will be it will result to time value of money. Please let's remember, there will be time value of money. Because why? Because the number of years in which you are going to incur that the commissioning cost is in the future. It's not now, it's in the future. So that cost is going to be incurred in the future. So you need to discount it to present value. So you are going to be giving annual discount rate. So the annual discount rate is 12%. And in ACCA, they make life easy for you. They will give you, you don't need to press calculator in the exam. Although there is calculator in the screen, there is calculator, and you'll be allowed to take in calculator, but they will make life easy for you. So they have already give us the discount rate of 32.2 cents. That means 0.322. When you press your calculator, 12%, you remember 1 all over 1 plus r raised to power minus n. So when you press your calculator, 1 or 1.12 raised to power minus n, you know our number of years now is 10 years. So when you press your calculator, you will get 0.322 something. But ACCA, they will make life easy for you. They will give you the answer you get when you press calculator. ACCA will give you. And the discount rate in 9.5 years is 34.1 cents. Now, I quickly want to ask a question. Now, this is a technical question. Now, this is a very technical question. And the question is that the 3 million naira that will be incurred by Delta Limited, in how many years' time are they going to incur it? This $3 million, which is number 1 estimated cost, in how many years are they going to incur it? That 3 million, anybody can anybody assist us? In 10 years, Abi, fine, that is fine. You are very correct, because they told us that the extraction the extraction is going to use 10 years. That's number 1. Then that land was purchased when it was purchased on 1st April 20x1. Abi, that is it. Now let me now go back to number 2. we have all agreed that they are going to spend 2 million naira. That means 200,000 naira times 10, Abi? 200,000 times 10 for 10 years for extraction process. How many years are going to spend? How many years is it going to take for them to spend that 2 million naira? How many years? Is it going to be that 10 years? Is it going to be that 10 years, Abi? I'm asking a question. 10 years, Abi. Okay. Mr. Kennedy to say yes. And Mr. Kennedy to okay. So everybody agree that it's that 10 years, Abi. Okay, 10 years. So now everybody has said it is 10 years. Now let me see. You are all just like my lecturer, Prince Casimir. He will tell you that you are all correct. You are all correct. Even though you are not correct, but you are still correct. So let me use his language. So let me tell you that that is wrong. That is wrong. Now, there's something I want to tell us here. Okay, Mr. Motola said, okay, 2021 will be prorated. 20x1, okay, it's an attempt. It's a good attempt also. Now, let me give you an insight. Number one, whenever ACCA give you an information, ACCA, they test question based on how you. Okay, someone said, how did we say we get 0.32? I said it that, okay, this is ICANN, this is not ACCA. Let me say it. For you to get your discount rates, okay, Miss Miracle said that extraction started on October, Abi. Thank you very much. Before I go back to that, let me quickly say this. Please, we are now in professional level. We did PMO when we are in skill. We did PM and we did group accounts. Whenever we are doing time value of money, whenever you are doing discount rate, this 12%, you are going to find the discount rate. And for you to find the rate, you press your calculator. 1 all over 1 plus R raised to power n, or 1 plus R raised to power minus n. So when you press your calculator, 1 plus R, what is R here? Rate, which is 12%. So when you press your calculator, 1.12 raised to power minus 10. N here is 10, 10 years. So when you press 10, when you press your calculator, you get your 32.2%, which is 0.322. Please, let's remember, we are now in professional. And I remember we are still going to do SFM, where we are going to be pressing calculator like. We are going to be pressing calculator. Please, let's take note. However, in ACCA will make life easy for you. And that is why ICANN is changing it to CR. From CR, it's changing to SBR. You are doing SBR now. So in ACCA will make life easy for you. They will give you the rates. You don't need the calculator again. So this is what you are just going to use. This 32.2 is what you are going to use. When we want to use it, I will show you. Just calm down. That is number one. Then is it Mrs. Miracle or Mrs. Favors? Give us one information now. This number two, when I said in how many years are we going to incur this 2 million naira, which is 200,000 times 10? How many years? I said it. Look at the information. They said Delta began, please look at my mouse. Delta began extraction of mineral resources on 1st October 20x1. So that 200,000 is going to be used from 1st of October 20x1. You know the land is going to do what? The land was purchased in April 20x1, and they started working on the land. So that is the reason why that 3 million naira is 10 years. But the 2 million naira is not 10 years old. It's 9.5 years. It's 9.5 years. And that's the reason why I'm saying ACCA, they test question based on the way you can able to raise it. They have already give us one information here. Here, let me show you. Let me show you that information here. Let me highlight it here. Now we cannot see it. They said annual discount rate is 12%. The present value in 10 years time, the $1 payable in 10 years time is how much? Is 32.2 cents, right? They give us that information. And the annual discount rate of $1 payable in nine and a half years. So this information they give you is not for more. Although there are some information they will give you that you don't need. That when you read it very well, you just overlook it. I don't need this information, Joe. I don't need this. I don't need it. But there are some information they will give you. So this now the case is for this one because extraction process started on 1st of October. Look at it. Delta began extraction of mineral on 1st of October. So from 1st of October till the year end of the accounting year end of the business, which is 31st March, it is 6 months plus 9 years, 9.5 years. Please don't let us sleep. Please don't let us sleep. So now we have highlighted the information. So now let's solve the question together. Let me show my Excel. So let's quickly work on this. And please let's quickly go and sleep. At least by 11, we are going to be done. So are we still together? Yes, we are still together. Now let's pick it one after the other. That's the reason I don't want to share my screen. This message will be disturbing us. But for us to solve this question, now let's go to our Excel. Now, exhibit 2. So for we to start here now, we are going to have a working note. But please, in exam mode, maybe the next time I want to solve for you, please, your solution should be up. Your solution should be up. Then workings will be down. But this is classic. Oh, please, just let me do it now. Now, people will not forget. Your solution should be up. And what will be your solution? Look at it. Let me show you here. Let's copy and paste. This is it. They are using the same here. Just pick it like this. Just show it like this. This is your POL, Abi. Now let's paste financial positions. Let's paste it too. Let's paste it here. So can you see it now? In your solution page, especially most of us coming from skill level, please, your solution should be the first page. When you are solving a question, your first page will be your solution. Just open one page like this. Do your POL, do your financial position, do it like this. You now go to next page. So when you go to the next page, you now do your workings. So for here, we are using the example. Now let's put our workings here. So workings 1. So working note 1 is what is happening to this Excel? Cost of the assets. So cost of the assets. What is cost of the asset? Let's pick it. The land is 10 million, right? Then they incur another cost of land erecting equipment, which is 3.5 Abi. So let's put it here like this. Cost of the assets is, let's use it like this, dollars. Okay. Let's use it like this. Land, which is 10 million. Then what is that second cost to? That second cost is equipment that 3.5 million. Equipment is 3.5 million. So our total cost is what? 13.5 million. So that is our working note one. Right? This is our working note one. Now our working note two. Let's go. What's our working note two? Now, Delta started extraction of mineral resources from it on 1st October 20x1. There was, okay, all those information is key. Now they give us the useful life of the asset, which is 10 years Abi. Now, did we calculate that depreciation immediately? Now, let's calculate depreciation. Let's calculate depreciation immediately. Depreciation. So, depreciation is how much? Our depreciation will be okay, 13.5 million divided by 10 years, right? Divided by 10 years. So, and that will give us what? And that will give us, now it is very, very, please let's take notes. Please let's take notes. It is very, very important. I wish I can unmute our screen here, but let me show us something here. Now, land was bought in April, right? When is the extraction? When was the extraction? When did the extraction commence? When did the directors determine that okay, that extraction is going to give us sufficient minerals? When was it? It was 1st October. It was 1st October 20x1. So now, please let's remember, because we buy the land on 1st March, does not mean that we are going to use the land. Thank you. That's what I want to quickly clear. It was only the land we bought on 1st April 20x1. When the asset is available, if you remember our depreciation in line with our year 16, depreciation commences when the asset is available for use. That means when it is start working. So here, depreciation will commence on 1st of October. Please let's take note. Depreciation of this asset will commence on 1st of October. It's not 1st of April. Because from 1st April to 30 September 20x1, Delta was preparing the land. Delta was still preparing. So it was on the 1st of October. That's when Delta, the directors now know that, okay, there will be a sufficient mineral. That means future economic benefit. That I told you guys that future economic benefit is now flowing. It was that 1st of October. So from 1st of October till the accounting year end of the business, which is 31st March, they told us to show this event in the financial statement as at this date. So from 1st October to this date, it is 6 months. It is 6 months. So when you want to calculate your depreciation for the year, it will be depreciation of 6 months. It will be 6/12. Please, let's take note. Let me put it here. 1 October 110 20x1 to the accounting year end of the business. Accounting year end of the business is 31st March 20x2. Please, let's take note. It is 6 months. So the depreciation you are going to charge is only 6 months. It's not 1 year. It is very, very important because this asset was available only when it is available. That's when we are going to be using this asset. So our depreciation will be how much? Our depreciation will be 0.175. This thing might cost wahala. Let me do it like this, because let me add 3 zeros. Let me add 3 zeros. So if I add 3 zeros, this one will be what? This one will be 10,000, right? Do you still agree with me that this is 10,000? And this one will be 3,500. So that this one will be 13,500. Then this one will be, and I'm doing it because of this. Because while will just happen now. So this one now. So are we fine now? Our depreciation, are we fine? Can we move on? Is our depreciation good? Fine. Can we move on? Let me see your reaction. People are sleeping. IAS 6. What is IAS 6 again now? Let's take it one after the other. The present value, we are going to get there. We are picking it information by information. Please, we are picking it. It is only the land. It is only the land that is. And sorry. Land is not depreciable. Please, let's take notes. Sorry. I think I need to quickly correct this. It is only 3.5 that we are going to depreciate. Sorry. It's only land that we are going to, it's only that equipment that we are going to depreciate. Please, let's take note. I'm very sorry. Someone just call my attention to it now. It is only that equipment of 3.5 we are going to depreciate. Land is not depreciable. Please. Land is not depreciable. The only land that is depreciable is what? Is leasehold land. Land that you lease. It's only that one that you can depreciate. So hope you understand what I did now. Hope we are fine. Hope we are on the same page now. Okay. It should be 3,500. Yes, I've corrected it. It's 3,500. Yes. Land is not depreciable. So please, let's take note. Land is not depreciable. So we are not going to depreciate land. So that 10 million naira, we leave it. Is that 3.5 million is what we are going to depreciate. So you say 3.5 divided by 10 years times 6/12, which is 6 months. So please, let's go ahead. Time is going. You see, we are picking it information by information, Abby. Now, let's move to the next information. They said what? They said um the process caused damages in the land. Number one, Delta began extraction of minerals on 1st October 20X1, and the director estimated that the sufficient minerals to enable the site to have a useful life of 10 years. We have done that. Further damages to the land caused mineral to be extracted. We are fine. Now they told us that there is an obligation, Abby. They told us that there is an obligation. So now let's pick it one after the other. Let's pick it one after the other. They told us that there is 3 million naira cost. 3 million naira cost to rectify damages for land preparation. Now, let me pick it. Let me copy this now. Let me copy this. It will be very useful for us. It will form our working note 3. Now, let's go. Our working note 3 will be, they told us that we have an information. What's the information? They said information is that Delta is has obligation. That means there is a decommissioning cost. So we must do what? In line with IAS 37, we must make provision, Abby. We must make provision. So that's our working note 3. Provision, our provision for what? Provision for, I've copied, provision for land preparation. We make provision. So how much is the provision for land preparation? They already told us that it is 3 million, Abby. They already told us that it is 3 million. Now, if you remember, for us to calculate depreciation, we must what? We must discount with the present value. And when we want to discount it to present value, we are going to use discount rate of 12%, right? Abby? Yes. If you remember very well, we are going to use a discount rate of, let me show us. Look at it. The annual discount rate is 12%. The present value of 1% payable in 10 years' time. You know, for the land is 10 years. But for that equipment, which is extraction process, that one is 9.5 years. So this is the discount rate they are giving us. But if you want to press calculator, press your calculator. 1.12. 1.12 raised to power minus 10. Press your calculator. Let's see what you are going to get. You see that you get the same thing with what the examiner gave you. So they have already given us. So for you to find your discount rate, for you to find your provision, you just do what? Let me put it here. Multiply by 0.322. So when we press our calculator, what is it going to give us? I wish I can unmute my screen here. I wish I can unmute people here so that, but people are going to abuse it. And I don't want that. Are we fine with this provision? Are we fine with this provision? Please let me see your reaction. Okay. That provision for land processing, we must make provision for it. So, because, and they already give us 3 million. You know, we have found our 3,000. So 3 million multiplied by 0.322. So let me help you. Let me assist you here. In case you call it 1.12 raised to power. Where is raised to power on Excel now? Raised to power minus n, which minus n, 10 years. So when you press your calculator, you get 0.22 in 3 decimal places. When you multiply, you get your provision. So let me quickly show the accounting entries. Because when we start adding now, people will be asking me, Mr. Taufik, how did we get this? So this provision, This is the accounting entries. We are going to debit something and we are going to credit something. So this is it. We are going to debit our PP. IAS 37 say we should debit our PP. With how much? Debit it to 966. Then we credit our provision. In the statement of financial position, we credit provision with 966. That is the accounting entries. So as we immediately solve that now, let's tackle down so that there will not be wahala. There will not be wahala. Now, immediately we debit that. Do you know that since we debit this, there will be additional depreciation because why? Because okay, let's pick it one after the other. Let's pick it one after the other. Let's pick it one after the other. Because there will be a depreciation again. But wait, let's pick it one after the other. Wait. Now let's go. We have working note 4. So we will calculate another provision. What is the provision? Provision for, let's copy this. But if we go to this place, now this second provision, do we remember the second provision? For extraction process. Provision for extraction process. How much is it? You know it's 2 million naira. Please let's remember. Where did I press? I go and cut it though. Instead of me to copy. Now, provision for extraction process. That second one, there will be a provision. So how much is that one? Please remember it's 2 million, 200,000 multiplied by 10 years. Happy? Multiplied by 10 years. So if you do that, then multiply by what? Multiply by, they give us the discount rate, which is 0.341. You know, they give us the discount rate. They already give us in the question. So what are we going to do? That will be 1.1, the same 12%, happy, but it will be raised to power minus 9.5. That one is 9.5. That one is not 10 years, it's 9.5. So if we press our calculator, what is it going to give us? What is it going to give us? It's going to give us provision. It's going to give us provision of how much additional provision. Now, okay. Oh, is somebody helping me to press calculator? No, I'm on my own. I'm on your own. I'm the one that will press my calculator by myself. So let me press my calculator by myself. It will be 34,100. It will be 34,000. So wait, just give me one. Okay, sorry. Let's continue. Please, are we still together? Are we people are sleeping? I find are we still together? Okay. Please be with me, or please stay with me here. Okay. Now we want to calculate that second position. Why are we multiplying 200,000 by 10 years? Yes, they said we are going to incur costs. Yes, we are together. Please, let's stay together. Look at the costs. They said 200,000 will be incurred for 10 years, for each year. Each year. So it will be 200,000 times 10, which is 2 million naira. Then, when is that course is going to be effective? It is on 1st of October. 1st of October. That means from October till year end, 6 months plus 9 years. That's 9.5 years. We have already said this before. Please, don't let us sleep over it. Don't let us sleep over it. It is very, very important. Now, let's go ahead. Let's go ahead. Let's quickly finish this question. Now, the provision for the extraction, the accounting entries, the accounting entries is going to be, now let's copy the accounting entries. Let's copy it. Let's copy it. We are going to do what? We are going to do the same as we did for working note 1. We are going to debit the PPA and we will credit the provision. So that's what we are going to do. Now, our depreciation now. Depreciation. Now, this extraction process, let's take note. The extraction process is it an asset? That extraction process, let's look at this together. This question, is it not going to cost wahala like this? Now, are we still together? Okay. Now, look at that 200,000. Look at it. Delta began extraction of minerals on 1st October 20x1. And the director estimated that there are sufficient minerals that will enable the site to have a useful life of 10 years from that day. Further damages are caused by the minerals extraction. So please, let's take note. This 200,000, it is provision for extraction process. Please, extraction process. That's what I want to explain. This is extraction process. Now, our accounting entries, these are our accounting entries. This is 3.4. We are going to debit something and we are going to credit something. We will debit something, we credit something. So this one is not an asset though. We are not debiting PPU. So we are expensing this one. We'll take it our profit or loss. This one is an extraction process. That means when you are doing extraction, that process will now cause damages to the community. So this is not an asset. So we debit profit or loss and we credit provision. Are you still together with me? What I said now, do we agree? Are we still with me? Without one number 4, provision for the extraction process is not an asset. And that's why I copied it. Hmm. People, let me see your reaction. If we, hmm. Let me see your reaction, please. Okay, 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 okay. That second one is an extraction process. The first one, why are we using 3.41 and not 6.81? Where did you get your 6.81? Please, madam, how did you get your 6.64? Where did you get that one? The examiner have given us, look at it. The annual discount rate in 1 year payable time with annual discount rate is 34.1, which is what? Which is, let me put it here, that is 0.341. This 34.1 cents is the same thing as this. That's why we are using 0.341. The examiner has given us. So where did you get your 6.4 again? Where did you get that one? I think you didn't multiply by 2 million. So, okay. Okay. Did somebody help me with the calculator? Let me, because my calculator, okay, where's my calculator? Where's my calculator? So when you multiply by 2 million, 2 million multiplied by that, what did it give us? 2 million multiplied by, we have 1,000. Please, let's let me press my calculator. 2,000 multiplied by 0.341. 2,000 multiplied by 0.341. Okay. Okay. Is 682 trillion. Is 682. Okay. But what about this first one? Are we correct with the first one? 3,000 multiplied by 0.322. 9.66. We are correct with that one. But the second one, thank you very much. Thank you very much. This is it. It's 682. Thank you very much. Let me copy and paste. Thank you very much. It is 682. Thank you very much. Let me give you top. Thank you. Thank you very much. Let me give you top, and I can't remember the person that's. Thank you very much. So we have corrected it. Yes. We can continue that. But please, do we still remember very well? Please, do we still remember that that second one is an extraction process? We are expensing it. Please, we are expensing it. We are expensing it. We are not capitalizing the second one. It's an extraction process, and we are crediting provision. So since we have done that one, now there is something we need to quickly do. Yeah. Now, since we are debiting, we have calculated depreciation before. We have calculated depreciation before. Now, we are going to calculate two depreciation, another depreciation now. This question is a very crazy question, and that's how ACCA comes. In the exam like this, you'll be sweating. So we will calculate another depreciation, or we take our depreciation. Let's do it like this. Let's do it like this. Let's do it like this. There are too many ways in which we can do something. Let's remove this depreciation from working with 2. Let's remove it. Let's remove it. Let our provision for this one be 2. Now, let's calculate our depreciation. Please, everybody, be with me. So depreciation will be there will be two depreciation. Abi, it will be 13,500. No, sorry. Depreciation will be 3,500, which is for equipment, right? Remember our equipment, 3,000. We are not going to depreciate land. Please don't let us forget. Plus this provision that we capitalize, 966. Huh? Who will help me to call figure? Who will help me to call figure? Who will help? I need somebody. Okay, Miss Deborah, please help me call figure. Thank you. Please, you help me with figure so that we can be faster. So now, there are two depreciation we are calculating. The depreciation for the equipment, the one we depreciated before, plus the provision that we made for land preparation, which is 966. So if you add both of them together, what is it going to give us? Please, what is it going to give us? 3,500 plus 966. What is it going to give us? Miss Deborah, I've had
4,466.
okay, thank you. Thank you, sir. 4,466. When we add both of them together, so our depreciation will be, it will no longer be 3,500 again. It will be 4,466 divided by 10 years times 6 over 12. Times 6 over 12. So our depreciation will be, what will be our depreciation like that? Our depreciation. What will be the total depreciation?
223.3.
223.3. Thank you. Thank you, sir. Thank you, sir. So that's our total depreciation. So this is our total depreciation. Now, our depreciation will be working load 3 Abi. Then our provision will be working load 4. Now, let's quickly do something. What will be our total provision? Because we are now done now. Total provision. We have two provision. Please don't let us remember. We have two provision. Provision for land preparation, which is our working load 2, plus provision for extraction process. The one we credited, this one, let me highlight it. We credited provision here, and we credited provision 2 here. These two provision, we are going to add it together. These two provision. So 966 plus 682, what is it going to give us?
1,648.
I can't hear you.
1,648.
1,648. Abi?
Or use the
Yes.
equal sign.
I can't hear you, man.
You can use the equal sign, then pick the cells and add them
Oh,
up.
yes. Okay, yes. So I want to
Automatically give you the total.
yes. I can do that. I just want to carry the class. This is ACCA, you do ACCA with Excel. So that is different. So I'm aware of all this. You do ACCA with Excel. So, but I'm just trying to carry the class along. So this is the total provision that will be recognized in the balance sheet. So we have the last thing we are going to do. So anytime we have a provision, there must be an unwinding cost. Unwinding cost. That's unwinding cost unwinding cost, which is accrued interest. Anytime you have provision, anytime you have time value of money, there must be an unwinding cost. Unwinding costs on provision. That means on every year, we are going to be calculating unwinding costs on that provision. So unwinding costs will be of two ways. It's just 12%, right? If you all remember very well, it is 12%. So we'll be calculating unwinding costs. So let's calculate unwinding costs on provision. So the unwinding cost will be 12%. What is our total provision? Our total provision is okay, we already have the figure. 1,648 multiplied by the unwinding cost of 12% multiplied by 6/12. Why? Why is it 6/12? Please, let's remember that when we started the provision itself, look at the provision. That land, which is an asset that we capitalize, that preparation started in 6 months time. So please, we are going to use 6/. That asset, we debited the asset. That asset till year end is 6/12. So, please, who can give me figure, please?
98.
I can.
98.8.
98.8. Okay. So I think that's all. That's all. The last thing that we can do, which is very, very key before we close shop today, is what?
Sir,
Is
this is
yes.
98.88. Sorry.
88, Abby. So it will be at 98.9. So the last one will be what? The last one will be carrying amount. The carrying amount of that asset. The carrying amount of that asset. You need to determine the carrying amount because we are supposed to show it in our statement of financial position. So the cost, how much is the total cost of the assets? 13 points. No? The total cost of the asset. Let's use our Excel, just like Madam told us the other time. Mrs. I've forgotten her name. So the total asset will be the total carrying amount of the assets. It will be how much? This, Abby, plus the provision, right? The debit that will debit the assets, then plus any other thing again? No. So it will be minus depreciation. Minus depreciation. If you remember very well, that our depreciation, to get our carrying amount, it will be 13.5 plus the provision that we debited in our working note 2 minus depreciation. That will be our carrying amount. So, sorry. Okay. Let me show it here. Or should I show it in? Time has gone. Let me just show it here. 13,500 plus 966 minus the depreciation. How much is the depreciation? 223.3, right? 222, 223.3. So when we do that together, we get our carrying amount of this. So now let's go. They ask us to show the financial statement as that. The problem in this question is that ACTI you should explain and show. You will explain, then you show. But here, if we say we should explain here, people will sleep, will not sleep here. So let's quickly show our financial statement extract. Let's copy this. Oh my God. So let's copy this. Let's copy this. In our profit or loss, what's the first thing we are going to show? Our operating expense, Abby. Let's our operating expenses. So the first thing we are going to show is what? Is our depreciation. Is our depreciation. That's the first thing we are going to do. We have calculated it before. Let's pick it. Our depreciation. What's our total depreciation? This is our total depreciation. This is it. Let's pick it. Let's pick it. Now, another thing that we are going to pick is what is our unwinding costs, right? Unwinding costs. Our unwinding costs. I think we can show, let's show notes here, because when we are solving, I think the depreciation is working on 3. Then our unwinding costs. What is our unwinding cost? The depreciation is working on 3. Unwinding cost is working on 6. Our unwinding cost is working on 6. Let me put it here. So what else again in our POL? I think that's all. That's all in our POL. That's all in our POL. In our statement of financial position, we have the non-current assets. Abi. We have the non-current assets. The non-current assets. So under the non-current assets, we have the land and mineral equipment, because that asset you get as P. So what are we going to pick? We are going to pick the carrying amount. Please don't let us flip over it. We pick the carrying amount, and that's why we calculated the carrying amount. That's it. So that's number 1. Then we have coin liability. Coin liabilities. Our coin liability. What's our number 1 coin liability? We have provision. Provision. Provision for what can we call it though? Which note is our carrying amount? I think it's the last note. This is working note 8. Now provision. People have slept though. People have slept.
Sorry,
Like,
We are here, sir.
thank you. All right, we are no problem. No problem. So provision. So these are provision. Provision for land preparation and extraction process. And that's the reason why extraction process. So I think that's all. That's all. Now, we still have one item before we go. This cost that we expense, this cost that we took to our profit or loss. Do you remember this one?
Yes, sir.
Please don't let us sleep. I've even forgotten. Provision for extraction process. Let me copy it like that. It's going to our operating cost. It's going to our POL. So, provision for extraction process. We are going to expense it. We didn't capitalize it. We expense it. Working note 4. Working note 4. I think that's all. Provision for land. This one, which working note is that? Before people will come to my DM tomorrow. That's total provision. Working note 5. I think we are fine now. That's our financial statement extract.
Please, sir, I want to remind you something. I don't know.
Okay. Please
In
remind me.
case you are sharing this Excel, can you kindly disable editing so that no one will tamper with the workings?
Really? Okay. Does people no? Because
No, I'm
when
just saying it's possible if you leave enable editing, one might edit and it might affect every other person. I
It's going
don't
to share
know.
it as PDF. It's going to share it as PDF. Don't worry.
because
Okay.
immediately I share it, Sha. When you download your own, I don't think it's going to. Nobody can compound it. I don't think so.
Okay. Thank you.
Yeah.
We get it individually, so there's no.
So individually, so it doesn't. Do we have any question? I think we don't have question. Please.
Sir, please, I have a question.
Okay.
So, are we the extraction? Is
Yes.
the profit or loss extra supposed to balance, like, sorry, for the financial position, is it supposed to balance, like, for the current asset? Just an extra.
No, just an extract. They just ask us to show it that okay, how is this one going to be reported? How is this one? This depreciation, this asset, how is it going to be reported? So it's just an extract. It's not going to be balanced. Not going to be balanced. So, Miss Titi, please, can you quickly go ahead?
Please, I wanted to say that please don't forget to drop the question. I don't have the question, please.
I will drop the question and the solution. In fact, when we log out now, I'll quickly drop it because my DM is just full now. Mr. Kavik, please, where is the question? So I'll quickly drop it so that me too, I'll go and eat and go and sleep. So,
sir, please, with the notes also.
With the notes, okay. 3 of them, I'll do the 3 of them. So I think we can. Okay, Mr. Olanka, any question? Okay, you can go ahead. You can go ahead, Mr. Olanka. Mr. Olanka, David. Yes. Please go ahead.
Sir, it's concerning the unwinding cost.
Yes.
I thought it was meant to be split. Because when we are doing the provisions, we debit the assets. Then for the provision of land preparation, we debit the asset and we credit the current liability.
Yes.
So now for the unwinding cost now, so are we going, like, I thought we are still going to add it to the assets, then still debit the liability for the provision of land preparation?
No. For provision for land preparation, that second provision, right? You mean the second provision? Abi?
Yes.
So the second provision is extraction process. That one is a process. So we debit our P or L, then we credit our provision. So, however, yes. But please, let's take note. What we did is correct. We can split and we can merge it together. Do you know why? Because this our credit is provision. This credit is provision. And the second credit too, which is our working note too, is provision to this one too. Is provision. So and whenever there is a provision, and remember that this one is 10 years and this one is 9 years, there will be what? There will be an unwinding cost. There will be an unwinding cost. But the difference there is just like this second one, extraction process, we will be spending it every year. In year one, we will spend 6 months. But the next year, we'll be spending it every year. So invariably, thank you for reminding me about that. There's one correction I need to add. Now, this provision, there is a need to split the unwinding cost truly. Yes. Because the second one is yearly. That 200,000 is every year. So when it is next year, they will make provision again, 200,000. So that one, there will not be an unwinding cost. So please, let me quickly split it here. Please, Mrs. Who is that woman that usually help me with calculator here? This one will be 966. Thank you for just, maybe because I'm hungry here. So what's the figure here? The provision, the unwinding cost will be on that, only this 966. It will not be on the total. Because why? The first one is a 3 million cost that will be incurred in the next year, in the next 10 years. But the second one, it is every year, each year. So it is each year they will be recognizing provision. So we are going to split this. What is the figure for this one? Please assist me with this figure. Immediately
57.96.
57.96, Abi?
Yes, sir.
Thank you. So the unwinding cost for the first one, that's what we will make provision for. Now, the unwinding cost for the second one, how much is it? That one is 682 now. We need to split it. 682. We need to split it. This question is a very technical question, right? A very, very technical question. IAS 16 and IAS 2 wireless standard. They now join it together. So please give me a figure. The second one.
40.92.
40.92. So this is the, so we are going to split it. So when we go back to our POM, this provision, this unwinding cost will be split. Let me insert unwinding costs and provision.
Please, am I the only one not seeing your screen?
You haven't seen my screen? Wow.
Huh?
It's your network.
Yes. I think you are the only one. No. Your network will come back, don't worry. Yes, your network is coming back. Then the second one, it will be unwinding cost. So we need to split it. Although when we add it together, is it the same? When we add it together, is it the same?
It's still the same.
Is it the same? Man?
Yeah, it's still the same, sir.
But it makes sense for us to split them because that second one is year by year. It's every year, each year. It's each year. Now I get it. Thank you for reminding me about this. Where is that second one? This second one. Now this second one. You remember it is each year. Sorry. This second one. Let me just. This question is a crazy question. I just remember now. This question is a crazy question. This second one, that is this one. You remember that we multiplied 2 million naira when we are calculating the provision. But when we are calculating the unwinding cost, we will not use 2 million naira. Please, let's take notes. We will not use 2 million naira. Hope I did not. Yes. Okay. We are not going to use 2 million naira. This question is a very crazy question. Please, are you guys still with me? People have slept.
Yes, we are with you. We are.
Yes, okay. What I'm trying to explain, what I'm trying to explain here is that when we are calculating provision, we use 2 million naira because we need to discount happy for 9.5 years. This one. But when we are calculating unwinding cost, it is every year 200,000 for each year. So for us to calculate this unwinding cost, it will be unwinding cost for only 1 year. It will be unwinding cost for only 1 year. So let me do the workings here. It will be 2 multiplied by, who can help me press calculator? Discount rate of 1 year, 1.112 raised to power minus 1, only 1 raised to power 1, 1.1 raised to power minus 1. It will be 0.893. Then multiply by 6/12. Can people understand like this? This one, it is not 2 million. This one, it is 200,000 every year. So the provision will be only 200,000. Only 200,000. Not 2 million naira.
Please, can you come again with that term discount?
Okay.
Discount factor.
Yes, let me show you. Let me show you what happened here. This 200,000. This 200,000. When we are calculating unwinding costs on the second provision, I said we will split it. This 200,000 is the unwinding cost will be on 200,000, will not be on this 2 million. Because 2 million is for 10 years. 2 million is for 10 years. But this unwinding cost, it will be only 1 year. So it will be 200,000 multiplied by 0.993. 0.893 multiplied by 6 divided by 12. So it will be, maybe this one is 2 million, Abby. This one is 2 million now, but this one is 200,000. So we are correct. So it will be 200 multiplied by 0.893 times 6 divided by 12. So this one would be 89.93. What is going to give us?
It's 9.3.
89.93.
It is 9.3. 9.3.
It's 9.3, okay.
Yes.
So that will be the provision for this one. not this one. Because this one is yes.
How do we get that discounted factor?
Yes. This discounting factor is for only 1 year. So it will be 1.1 over 1.12 raised to power minus 1. Year 1 only. It will be year 1 only. It will not be 10. Your number of years will not be 10 or 9.5. It will be 1. So if you press your calculator, 1 divided by 1.12, or hope you get, if you press your calculator, you get it now. Did you get it? That's our discount factor. So this will be, these are, this is it. We are going to split it. This question is a very technical question. But under exam condition, please don't kill yourself. Even though it's 7 over 10, you can get all those depreciation is mark. All those depreciation, they are straightforward. You get your mark. This unwinding cost on extraction process. Let me change it. Extraction process. It is every year. That one is every year. 200,000 every year. So it will be very low to use now and the half years to calculate the period because the 200,000 is every year. So the unwinding cost is just like, in fact, so that is it. That is it. It is just 6 months. The unwinding cost is just 6 months. 6 months. So everybody, are we together? Hello?
Yes, sir. Yes, sir.
Yes, sir, we are together.
Yes. In fact, I think I should remove that unwinding cost. Since it is every year, are we going to pay any interest? Okay, let's leave it.
Yes.
Yes, we are going to pay that 6 months interest. Since it's a provision for 9.5 years. So let's leave it like this. So I will send the Excel now. This is 11:30.
Sir, but I have questions, sir.
Okay. Mr. Adebayo.
Okay, sir. Thank you. Hey, regarding that unwinding cost, because of time, I'm just thinking that is there need to split? Since whether we split it or not, the same accounting entries will still apply to the lump sum or the split figures.
That's why I said it the other time that it's not compulsory. Since we got the same answer, it's not compulsory we split. We can leave it like that. But for reporting purpose, it is better to split to show that they are different. Yes.
Okay, sir. Secondly, sir, sorry, as you have advised for the ACCA question, how can we get the soft copy? Sorry, just to lay our hands on the questions. I don't know. You say where we can tackle and we can bring, if there's anything.
Okay, no problem, but no problem. If you need it, you can send a DM to me. I will send you a soft copy.
All right, thank you, sir.
I will send a soft copy if you need to. Because if I send it to the group now, it's not everybody that needs it. So, but if you need, I will just send you like few years a soft copy that you can be seeing standards.
Okay,
so,
sir.
Yes.
I will appreciate that.
No problem. So, we all need to. Okay, is everybody that need that? It's not everybody that need to.
So everybody need it too. I need it also.
You too, you need it. Okay. No problem.
The main aim is to pass. So.
Yes.
I think to better reduce your workload, you can send it to
the group, Abi. Okay. No problem. I'll send it. That we can just use to practice. So any standard we treat, you can just go to any question. Okay, this one we can. So I'll send it. No problem. So I think that's all for tonight. So let's call it a day. So let's go and rest. Tomorrow there is work. So our class continue next week. And just like I said, it is my colleagues. It's my colleagues that will be taking you standards majorly. It's my colleagues that will be taking you standards. I will be taking you like group accounts. That's where I'm going to, starting from next month. I think next 2 weeks, first week of August, we are going to start our group account. So I'm going to be the one that will be taking you group accounts. And that's how it has been since all this while, from now till October. Group account is very wide. All the subsidiary, foreign subsidiary, associates, fellow subsidiaries. So, in case you did not see me that Mr. Taufik, where did you now will not take off standard? That's it. That's how we just split it. That my colleagues will be taking you standards, then I'll be taking you group account. But at the end of the diet, when we now do revision, we will all now take you standards and group account together. So that is it. So that's where we are going to end the class tonight. So thank you very much, very well. Thank you. Good night,
Thank you,
everybody.
sir.
Yeah, welcome. Good night.
Good night, sir.
Good night.
Good night, sir. Don't forget to send the note.